All right, let's transition into our last segment here, which is going to be the Queen's Court. And, Queen Emily, we've been doing this now for 3 months or so. Each and every week, we come together, the three coaches here that are on the Tuesday show, find a stock, an investment idea, some analysis behind it, and present you with either a trade concept, an investment concept, or somewhere in between. Emily then gets to decide whether or not it's good enough for the analysis and the pick and the market conditions at the time. And if not, she chops off their head. Emily, where do you want to start here today?
Oh, I don't even know if I even have the ability to chop people's heads off. Like I said, I've been getting butchered on fantasy football. I don't even know, but markets are down, so definitely gotta chop some heads off today since I didn't chop anybody last week or the week before. So let's start with you since you are driving today. Why don't you go ahead and give me what you're looking at?
Well, there's a couple things. And I was talking this morning, thinking through where the market conditions are, talking to Matt as, he was breaking down the technicals in pre-production, and talking to Mark and everybody about the news. And Matt, are you back there, my friend?
I am fantastically back. Yes.
He brought his sword. He's like, it's.
I brought something.
Maddie, I'm dropping screen. You take over. I need you to drive in my life. I'm like the guy who's just like sitting on the side seat. There's no question about it. You're my driver. We're talking Queen's Court. We're getting started here, and I'm going first here, Matt.
I'm watching Driving Miss Daisy later tonight.
That show didn't end well for two people in a car. I'm going to tell you.
I'm just saying.
Oh no, I was thinking about the women who drove off the cliff.
Yeah, I was going to say that.
What was that?
Thelma and Louise.
What is wrong? You know what? Tim, I'm chopping off his head. I don't even
you have no chance.
I don't even need to hear what you have to present. You're done.
Well, while we're talking cars.
Driving Miss Daisy and Thelma and Louise.
That's a tough one.
I've got a simple concept, not a specific trade or investment idea. Actually, with the market conditions the way that they are, I'm a bullish investor. Emily, I know that you're a bullish investor as well. I mentored you, and I've watched you over the years teach and coach and mentor other people, and the way that you approach the markets through your Dynasty Investor Trading Lab. You're a cautious, delta-based investor who loves cash flow. I know your systems very well. They're great systems. Here's something I'm seeing in the market right now. For those of us who are net bullish a lot, where we're looking for opportunities to add delta equity, whatever it is, we might be carrying a little bit too much positive delta in a condition that's moved more neutral. Doesn't mean I want to go bearish, but I think a hedge right now is an idea that people should be presented with so they at least have the choice. Matt, give me just the SPY. I looked at the Qs. I thought about the Qs. I thought about some other markets. The SPY is where I'm going to go with this one for a couple reasons. Same reason why we start with it every day. It is that broad-based, balanced approach to the market. It's got all the sectors in it, 500 components. It's not just industrial, financials heavy like the Dow. It's not just tech heavy or cyclical heavy, kind of like the NASDAQ 100. So we're going to hedge with the SPY. And we're going to add a simple delta hedge against people who might have too much bullishness, right? It's kind of like if you're driving down the highway, you're doing 15 miles an hour over, you might want to tap that brake just a little bit. That's what a natural bearish hedge is. Matt, I think a simple bear put spread, go into the trade tab, and I looked at the different months. I thought about shorter term because I'm not really concerned through the whole end of the year, Emily. I'm really only concerned right now until the market can find support, on the intraday, start forming some analysis, all that kind of stuff. November was the sweet spot for me. And Matt, if you go to the put side over there and find me that, I had mapped this out at the 435.50 delta contract. So we're going to buy a put, Emily, which is a direct bearish delta. But you're a cash flow trader, and I don't think that you want to add just all that negative theta to your account. So I'm going to offset the time decay by going deeper out of the money, selling a put against it in what is a traditional bear put spread. Now, let me be very clear, Emily. I hope this loses money, because if it loses money, kind of like a lesson Tyler did in Jedi Options over the last couple of weeks.
What was your strike sold?
435, and then I sold the 415. I did a 20-point spread. It was about a 20-point wide one and about a 21 delta difference in there. Okay. Mm-hmm. So I've got a 20-point hedge. It's going to cost around $5 to do it. And yep, I believe it might have gone up a little bit, but around $5, I think. Here we go.
528.
528. $500 on a 20-point spread gives me a lot of room in that spread to build some extra profit from this trade if the markets do drop further. If the markets don't drop further, I've got my core holdings. You've got your core holdings. You write covered calls. You lock down risk graphs. It's a simple trade. It's a way to reduce delta, give you a little bit of peace of mind. And the beautiful thing about it is if you truly understand portfolio design, all you're really doing is tapping the brake a little bit to give yourself a little breathing room here. This is my trade for the day. This is my pick for Queen's Court. There you go, my queen.
Can I say something to it?
Mm-hmm.
You might get your head chopped off.
I might get my head chopped off.
Yes. I'm going to do it anyways. First and foremost, I love this concept. And the reason is very simple. Tim has a portfolio that is long delta, like many participants. The high majority of market participants has a net bullish delta. Mm-hmm. Tim has a net bullish delta right now. He's looking at that support level that we've been talking about all day today. He's looking at that and he's saying, you know what? I want support to hold. I do. I want support to hold because if support holds, my banks work out better. Mm-hmm. My energy holdings work out better. Well, energy holdings might work out regardless. But my technology plays will look a heck of a lot better. We'll recover some of that short-term pain, right? Everything gets a little bit better if support holds. But if the dam does break, we all know what that volatility can look like. And you never know what occurs, but if you know what that volatility looks like and you have the ability to offset some of that in the moment, I think that is a very valuable technique to possess in your arsenal, in your trading arsenal, right? You're simply saying, I'm not that concerned about the market that I'm just going to go out there and go, net neutral and I'm going to lock everything down. And that's what that put option does when you come to the risk graph, for example. And so when you're in the risk graph, and let's say you own 100 shares, I'm sorry, the educator in me can't stop. Let's say you have 100 shares of the spiders here, right? Just to represent your portfolio, right? Just to represent your long-term portfolio. That's what the risk graph looks like, right? If you were very concerned about the marketplace in the short or intermediate time frame, you certainly could go out there and say, I want to lock this bad boy down. I'm going to go net delta neutral. I have 100 shares of the spiders. I'm going to go net delta neutral, and I'm not just going to buy one put option. Oh, no. I'm going to go out there and we're going to buy two because my delta is 50 that excuse me, let me get the right one. I bought a call. We were going to double up there. Just, excuse me. We were going to double up to catch up there. Yeah, let's go. I'm not going to go out there and just lock it down. I'm going to go net delta neutral, which means if I have 100 shares of the spider and a one delta, I got two contracts with 50 deltas. I am going lockdown mode. And that's the risk graph that creates, where you basically say, I'm taking the risk to neutrality. Go down, I don't care. Go up, I don't care. In a neutral environment, I will lose my theta, is basically what I'm going to lose. Well, you're not that aggressive. You're not that concerned. If you're just slightly concerned, well, you can go out there and you can do a slight hedge called a put option, which will give up some of the market gain, but it locks down the risk graph to the left side. You control the risk that way. Again, I don't think you're that concerned at this point until we start to see weekly charts double top and double bottom and those. What we're concerned about is the short-term technical price action, not the fundamental value of the entire marketplace right now. And so what Tim says is, I just want to mitigate slight delta. I don't want to reduce all of my core holdings because this is just a short-term situation, and I'm not going to freak out in front of Santa Claus. What I'm going to do is I'm just going to add a slight bearish hedge against the marketplace so that I can adjust my risk graph just slightly, so I can take out some of the hypothetical concern if the short-term support level breaks. And so as you can see, all we did is adjust a little bit of that short-term pain just in case the dam does break. And so I just wanted to take a moment just to kind of explain the thinking towards this conservative hedge versus what an aggressive hedge would look like.
I appreciate that clarification, and the picture does tell a lot of that. And if you go back to that Analyze tab here real quick, Matt, one more thing I want to highlight there, because I love that last view of the risk graph. You'll notice we still have risk to the downside. But like, for example,
it picks up once your hedge is gone.
Sure does. If it goes all the way through my hedge, well, then I've watched it go 20 points. I've mitigated some of the risk. I have other choices I can make as those weekly charts start to develop.
Think about it. Where does that risk really kind of build in? You're doing a credit spread, but at the end of the day, you do own a 415 put option, which gives you the right to sell the market at 415. And so you do have that control mechanism between 415 and 435 that ultimately, if you see the real pain take hold in the market circa pandemic, circa 2008, which I'm not there yet, we're just talking hypotheticals, you do mitigate a little bit of the damage there. And I think it's obviously, it's something that advanced traders will do in these environments to mitigate some of the short-term real damage, but also the hypothetical scenarios that may occur underneath support.
And I know my queen has a lead foot when she drives on the freeway. So maybe she doesn't like the idea of tapping on the brake. Sorry, I have to get myself loaded sometimes.
But, oh my gosh, Tim's nervous because he actually said my queen. Like, that's the first time in 7 weeks.
Tim should just not talk.
I'm done, my queen. There's my analysis.
Your strategy was good. Just know when to stop. That's all.
All right. Know when to hold them and fold them.
Did Mark go?
Not yet.
Mark has not gone yet, so let's have Mark go. But thank you for that. I like that, Tim. Thank you very much.
All right. Mine is Exxon Mobile. For me to get involved in a bullish trade right now, I got to have three things in these market conditions. One, I got to have a stock that potentially benefits, but at a minimum is not hurt by inflation or margin pressures right now. Oil traditionally in an inflationary environment does pretty decent. The second thing I have to have is I got to have a theme behind it. I don't have a broad market theme. I got to have some kind of theme. I think, and I outlined this, so I'm not going to, go over it, when we were talking about oil. I think there's a real genuine theme behind the supply demand that is becoming more and more prevalent. I covered that in oil, so I'm not going to read it. And third, I got to know, or at least have a pretty good idea on earnings. I don't want to get caught in a Nike or a FedEx situation where margin pressures or external things or lowering guidance. I'm not in the mood. The market's in an angry, foul mood. And even if it recovers, it's still, those earnings situations have been punished on an individual basis. I want to have a pretty good idea of what earnings entails. We've known the price of oil. We've known the price of natural gas. And I like that a big diversified oil company, because it's not just oil, a integrated oil company like Exxon, they have lots of exposure to natural gas, lots of exposure to crude oil. They're in the refinery, they're in the midstream, they're involved in the entire circuit of oil. Exxon Mobile fits that bill. I think, and I've talked about this before, Exxon's done amazing things from a fundamental cutting cost over the last year and a half, reducing debt. Their dividend isn't in risk. I like a go long uncovered here on Exxon as my pick.
Okay.
Did he just say uncovered?
He did.
Okay. Let's roll with the momentum. I like it. Bar by bar, Mark brings. I like it.
All right, Matt, you are up next.
All right. I don't have his confidence to bar by bar, which means I'm going to bring to the queen here today a little bit of what I've been talking about recently when you're talking about finding true value. And when you're finding true value of a company, we're obviously talking about something at the lows, but I do find value to be both from a technical perspective as well as from a fundamental perspective. And in a world that is a little bit crazy right now, with the wall of worry just coming at us nonstop, I'm going to bring a little bit of a boring upon boring, and let's add some more boring on top of that. And let's talk a little bit about Verizon here. I talked about it yesterday as well. Verizon is in that zone, right? And Tim asked me a question yesterday where he asked me whether or not I felt China at a low point was a potential buying opportunity. And I said, well, the evaluation is fundamentally different because I can't really do my fundamental comparisons against China because what's driving China right now is geopolitical situations. And all of those are very, very uncertain. And I'll just ask the same question I've asked quite a bit lately. Can anybody here tell me what China's trying to do from an endgame perspective?
No.
Because today I saw another headline that says they're willing to inject liquidity.
Mm-hmm.
Right. And yesterday I saw a headline that they were willing to do something different. So it's very uncertain when you're dealing with geopolitical situations that can shift with the wind. When you're talking about an individual company, though, within the U.S. ecosystem, you're really talking about the comparisons against like metrics from a fundamental perspective. We're looking at P ratios, PEG ratios, book to value ratios, and so on and so forth. But when you first talk about finding value, what I find it very helpful is to make sure that you really do see the value from a technical perspective as well. And that to me is all about the zone. And what I mean by that is the zones of support that start to build over time on these longer term charts, like Verizon, like an AT&T, like what we talked about with gold at 30. Yeah, gold didn't confirm at 30, but again, it doesn't change the metrics. It doesn't change the analysis. It doesn't change the opportunity that 30 did represent, and in my opinion, still represents, because when you do find a value, it's a value that you're willing to take a little bit of that short-term risk, given the fact that all the momentum is to the low point, given the fact that we're in a short-term or an intermediate downtrend. And so when you're looking at this from a technical perspective, you first start with historically, do you like the zone? And I like 54. I like the handle 54. Technically, you see 54 come into play as it started to get beat up coming into the year after the election last year. You saw it get absolutely blasted, but once again, you had a lot of evidence come here at 54. Spent 2 weeks during the pandemic under it, but even before pandemic, 54 really does stand out to me. And so first of all, I'd like to handle at 54. Now, would you like to see that coupled with a little bit of a breakout here at 54.70? Absolutely 100%. Maybe you wait for that trigger above the resistance levels to say I'm ultimately confident, or my confidence level is to the level that it needs to be at that point, but you like the zone. That's what you start with. The second thing you want to do is you want to look at the fundamentals as comparable to like-minded companies. It does nobody any good to compare the fundamental nature of Verizon to, say, Apple, for example, a discretionary technology stock, or to what is occurring in the energy space, given the fact that they had negative valuation last year, and those metrics are fundamentally different. What you got to do is you got to compare it to the sector itself, to the industry itself. And so when you're looking at the fundamental nature of the communication space, which Verizon is a part of, it is one of those value type opportunities, those dividend opportunities within the communication space. But Verizon right now is setting with a P ratio of 12, a forward P ratio of 11, And so when you're looking at that just from a pure metric, that tells you just that it has some degree of proper value, given that it's not over that generally accepted 20 PE ratio that has been standard for a very long time. But that, once again, is just something that Benjamin Graham said 70 years ago, Warren Buffett adopted, and thus all of the Buffett disciples adopted. But again, it doesn't really tell the story until you look at it compared to the sector. You're talking about a sector right now in communications that has some short-term technical volatility to it, tied a lot to the top of this area, the Facebooks of the world. We obviously know what the gamers have been doing over the course of the last 3-4 months, as they've been going through some tremendous downward movements in price. Verizon has been doing the exact same thing. Down, 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 down. Verizon, however, unlike communications, is down towards those ultimate lows where you would be like, yes, I like this opportunity. Verizon, in comparison to the sector, the Shiller PE ratio of the communication space is a whopping 56 right now, guys. One of the highest sectors from a valuation perspective. When you look at the communication space in general from a normal PE ratio perspective, it's rocking right there at about 30. Once again, a little overvalued, right around the 7th or the 8th most overvalued area of the market right now. But when you're looking at Verizon, a component of this space, a value opportunity of this space, it's not going to light the directional traders on fire, no doubt about that. But you're talking about a company that has a fair market value or under market value at a PE ratio of 11. It's underneath its industry, it's underneath its sector, and it's underneath the broad market itself. You're sitting at a technical level of 54. Now, why Verizon? Not from the directional perspective. Why Verizon is this? In this marketplace where we're trying to figure out what's happening with the growth sectors and what's happening with those defensive sectors, right? We're seeing a lot of movement in between those sectors on an intraday basis. In a world where you do have some degree of uncertainty, here's a couple things that are certain. 54 in Verizon has been a cement support level that certainly can give, but if it does give, you can offset that with the dividend payout on Verizon. And currently, I believe the dividend payout ratio on Verizon right now is right at 4.61%. So you can capture the 4.61%. Obviously, this is not a short-term scenario. We're looking at a little bit longer term here. But you can cash flow a little bit of that 4.6% starting at the low point instead of starting at the high point. And you can also, if 54 does give, Verizon's not going to give you a lot of cash flow. That's not what this company is. But you can easily come out there and mitigate about 1% against the price action per month if that dam at 54 does break, and you do need to lock that down with covered calls. You can mitigate a little bit of that damage. And in a market, think about it like this as well. In a market that's down 2% today, Verizon's down really, really big today. It's only down 0.78%. You don't need the 3% cash flow on Verizon to offset the volatility. You need the 1%. That's what you're going to get. You got an excellent opportunity, in my opinion, because of the zone at 54. I like getting in above the short-term resistance levels. No stop loss here. You're looking for cash flow. You're looking to mitigate damage under 54 with riding the covered call and capturing the dividend.
Okay. All right. So let's go back to the top and start with Tim.
Okay.
On SPY. So finally, you listened to where my bias is and where my posture is in the market. When I talked about, I'm neutral to slightly bullish and just reducing delta as the market is trying to figure out what it wants to do. And then you present me with an idea of what I could do if, to reduce that delta. So definitely love that idea where you're not aggressively going bearish and just going out there and just buying straight calls. You're doing a short-term bear put spread just because we are in this short-term downtrend, and while we're trying to figure out whether we're going to hold support or not. So absolutely love that. But I have a feeling that you threw yourself under the bus without even realizing it, because you said that you know me and you mentored me and all that stuff. And I'll have a question for you at the end, which was
Okay.
I'll get my sword ready.
Okay.
whether I'm going to
Okay.
chop your head off or not. So we shall see. But I absolutely love that. The month that you selected on the bear put spread, being that it's short term, everything about the analysis was perfect. And then Matt comes in and even goes into more depths and make it even more beautiful. But you're just going to die on a personal reason, but nothing to do with nothing to do with the analysis.
Somehow that is supposed to be better.
Now,
Good
Mark,
trade, but you're a horrible person.
Yeah, I'm not going to kill you because your strategy. I'm going to kill you because you're just a bad dude.
you always make
That's so funny.
Mark, on the other hand, brings up Exxon Mobile, and you already know that I have exposure to Exxon Mobile, and you learned your lesson from the last time when you asked me what I had exposure to, and then I think it was Bank of America and Wells Fargo, and
I had many choices. I brought your favorite.
Yeah, so don't know that I want to get, it's left me behind in some sense, right? Obviously I have exposure to it. I would have loved to pick up some more shares at that breakout at 50, but it's still running, and it's definitely got more potential to get back to those all-time highs. And this would be a long-term investment for me, so I wouldn't mind, adding shares to that. But if it's between Exxon Mobile, reducing delta on SPY, and now looking at Verizon over there, Matt. I like slow things, right? And I love where Verizon is sitting at that bottom. And this is again in communications sector where the sector itself isn't really doing that well, and Verizon isn't either, but it's got that support that it seems to always hold at 54. So and I was talking about this in the lab the other day where, people always talk about, well, I want to own this, I want to own that, but it's gone up too far. And then you get an opportunity to buy and you sit there and you don't buy it, and then it leaves you again, and you complain about it being too high. So, these are one of those opportunities where if you've ever wanted to pick up Verizon at a low price where we know support has held over time, nice dividend paying stock, not that great on cash flow, but still good enough. I mean, 1% is 1%. You're not going to get it anywhere else. I like it here. So if Tim does not butcher this, he lives. I would go with SPY, the hedge on SPY, or the reducing delta on SPY and Verizon, and kill off Mark. But I have a feeling Mark will survive because Tim will not have this answer. Although he knows the answer, it's staring him right in his face, but he will not know the answer. When is my birthday?
Hold on, there's somebody at my
door. Go to Facebook real quick.
Nope, can't cheat.
Is it today?
Nope.
Oh, that would have been terrible.
I know, if it was today, it would be terrible.
I gave you the hint in talking about the trade, but you're going to die just because you said you know me very well.
Rose's birthday was just a couple weeks ago. Yours is coming up very shortly. I think it's the exact date. I have to mea culpa.
This is how you die. Go to the options chain.
Is it that date in November?
November 19th.
Holy cow. Yeah. So I picked your birthday as the expiration day.
You picked my birthday as the expiration date, and you didn't even recognize it. And you claim to know me, but it's okay.
Emily,
throw me under the bus.
If you would have asked me, I would have known.
You would have actually, but all right. That is, first of all, now Queen on November 19th, when those options expire, happy birthday.
Exactly. When they expire worthless, happy birthday. It will be a good day if those options expire worthless on that bear puts.
100%. We want them to lose. We want them to lose.
Absolutely. We want them to lose. Absolutely.
Listen.
So Mark, you survived. Even though you beat me at fantasy football, Tim did not know my birthday. So he just dies on just not,